raising equity and putting debt on it is if you put debt on this thing, it puts a clock on the project. You know what I mean? Like that, the interest on that debt is going to, you got to pay that. And that is really not patient money, right?
Finance, then you could just pay that interest. And as long as you can be done in that period of time, then everything's fine. But if you're not done and ready to refinance it and get that construction loan, then you might find yourself in a pickle because all of a sudden your lender wants their money back.
Right. I mean, as soon as you talk to 4 or 5 banks, 2 of them gave you a term sheet. Now it's like you talk to 30 and maybe one of those gives you a term sheet. So a lot of banks have really shied away from it and absolutely take it, go for it. It's your tax dollars hard at work. Not everybody can get that. If you have bankruptcy in your past, tell the guy. If you don't, it's going to look like you're hiding something, probably going to kill the deal. But if you upfront about it up front, then, it's something that can easily get over, right? It doesn't matter how many times a guy buys you lunch. This thing's still getting underwritten.
Welcome to another episode of Real Estate Development Land to Legacy. Jake Clopton, welcome.
Appreciate me on.
Real estate development.
My day-to-day is running debt originations for Clopton Capital. I also started the company. I oversee the other verticals we have, which are equity originations, insurance, 1031 exchange, QI, sales brokerage, and commercial solar. But my primary day-to-day is arranging debt for commercial real estate transactions.
Okay, sounds good. And so what kind of transactions do you specifically focus on, or is it pretty much everything?
Well, I've been doing this for 16 years, so I've seen and done just about everything. I do fixed rate perm loans, acquisitions, refinances, bridge loans, and construction for all asset classes. I see a lot of really core stuff, multifamily, retail, industrial, straightforward acquisition refinances. But then I also do a lot of special use type product like hospitality, car washes, self-storage. I get a lot of stuff that private equity is chasing. So storage, mobile home parks, car washes have been really big lately. And then we also do some pretty creative stuff like in the historic tax credit space and stuff like that. So we do pretty much anything from just kind of vanilla product up to really complex capital stacks. Our capital sources are banks, credit unions, debt funds, life codes, government agencies, CMBS, all the above.
Okay, so you must know a lot of people then.
I know a lot of people. Yeah, that's a fair statement, man.
So what's interesting is that historically, when I talk to people that haven't done this, they typically, the first thing that they think when they need to get funding is their local bank. And they would typically call their local banker and say, hey, I need whatever, a couple $1 million for this and that. But from what you just said, there's a whole laundry list of different players that could loan you money. Where do you typically start? Or where would you advise for somebody who is looking at developing a project? They haven't designed it yet. They haven't done any work. They just have a raw piece of land. They would like to get some initial funding to get going. Where should they start?
Yeah, I mean, I think you're asking like what kind of capital source should they use? The way that I usually determine which direction it's going to go is I like to take this like top-down approach, right? I really like to understand the equity, right? Like is the project ownership like 1 or 2 guys? Are they comfortable with recourse, right? Are they going to personally guarantee it? Or is it a syndicated deal, right? Where you've got like a guy putting it together with like 30, 40 different investors and he's only going to own a slice and he doesn't really want to guarantee the whole thing for everybody else. I mean, if you are comfortable with personal recourse and, there's only a couple owners in the deal and it's not a very complicated kind of like multi-tier org chart, the lowest cost capitals out there is going to be banks, credit unions, like by far. If you have that really complicated syndicated structure, you probably need to lean more towards, like debt fund type of lending for like shorter term stuff like construction or bridge, or more like, non-recourse perm lending, like, if it's an apartment building, like agency type CMBS or something like that. If you're trying to decide what type of capital source to use, that is usually the first step. Like, what's the ownership look like? What do the guarantees look like, right? Because if you need that lower cost capital from like a bank, they're going to do full global underwrites and full personal recourse. And if you're only owning a portion of it, not everybody can do that.
So, can you educate the audience? What is a debt fund?
Yeah, I mean, it is literally a fund that raise money around putting out debt. The advantage to debt funds is that they're not regulated like banks are. So they can really kind of make up whatever their own strategy is and lend against whatever they want. Debt funds have really stepped into the commercial real estate space as banks have gotten more regulated, which they have. Right, that's the biggest issue that we run into lots of banks is kind of like their oversight of the FDIC, concentration limits, things they can and can't do. A lot of banks really don't do cash out, specialized lending, stuff like that, specialty properties. Think of debt funds as filling a gap where bank lending is leaving off, and either non-recourse lending or just things that banks just won't do right now. We're in a tight bank lending environment right now. So a lot of debt funds have stepped into the construction loan space where banks are really, struggling with that. Just a good example of where these guys are adding value. But you should most certainly expect a higher cost of capital from debt funds than banks. So that's the trade-off.
Right. So they're basically private lender, right? That can
Exactly.
be sometimes more aggressive than a bank can be. And maybe they can offer higher leverage or faster underwriting or just work with, I don't know, maybe less experienced sponsor. Right.
More of like an entrepreneurial type lending approach, an
Right.
opportunistic versus a very tight credit box that is slower moving and less opportunistic, right? But they most certainly charge for that. That's the biggest pain point with them.
So I'm working on this project right now, and there's a piece of land. I believe it's free and clear. No design work has been done. The property owner wants to put an apartment building there. And they're saying, we've got this property, it's free and clear. We don't want to invest any more money. If you want to, we'd love to partner with the developer, get it done, get it financed, whatever needs to happen. So I'm looking at it and I'm telling them, look, right now, because you've got this property, it's a good property, it's valuable, it's free and clear. Let's go to the bank. Let's take a 50% loan to value loan, pull that out of there, and that will finance our development phase, design and permitting for the next couple of years until we get the permits.
Oh, like doing pre-development stuff. Okay, got it. Yeah.
What do you think of this approach? That's historically how we've done it, but maybe there's a better way of doing that. We should refocus this and plan on raising equity first.
Yeah, I mean, you're talking like levering the property up like a conservative level to pay for pre-development costs and
Right.
entitlements, and yeah, I mean that I get more than enough requests like that. I don't think there's anything wrong with that approach. The difference between raising equity and putting debt on it is if you put debt on this thing, it puts a clock on the project. You know what I mean? Like that, the interest, you know, you got to pay that, and that is really not patient money. So that's the biggest difference. If you raise equity, the equity is going to go in the project, and you're going to have like I would say less stress as far as timing to get things done and to get things going. But as soon as you lever it with, a loan, um, you really need to adhere to whatever timeline you originally had. And if you have, let's say things taking longer or, mishaps or can't get approvals or stuff like that and delays, having that debt on there is definitely going to overhang an object. And I've just seen this time and time again, using debt to do pre-development costs that then need to be taken out by successive financing. I've seen a lot of requests for, you know, the second iteration of that pre-development. Right? It's like, hey, we got
Right.
we got a pre-dev loan to handle all these soft costs. Now we need to refinance it and get a little bit more money because those costs went up or it was taking too long or something. Right? So just keep in mind. I mean, it's definitely it's a fine strategy, but there's risk involved in it by putting a loan on it instead of raising equity.
Right. So, like anything else, there's a risk reward. Obviously, if you're raising equity, then you're going to have to share that equity with an investor, right? If it's all debt finance, then you could just pay that interest. And as long as you can be done in that period of time, then everything's fine. But if you're not done and ready to refinance it and get that construction loan, then you might find yourself in a pickle because all of a sudden your lender wants their money back.
Right. I mean, as soon as you put a loan on that property, look, it doesn't make money, right? So not yet, anyways. I mean,
Right.
you put a clock on the deal, and it's got to get done.
Right. Good advice. All right. What about construction financing? How difficult is it to get an apartment building financed these days?
Um, it I would say the answer depends, right? I'm doing a lot of construction lending right now. That's the hard things to do, right? So we're a capital markets firm. We're an intermediary. I usually see a lot of the stuff that's really difficult to get done, and the most difficult thing to get done right now is construction lending. We're doing a lot of it with banks, credit unions. It takes a much wider approach to getting good construction lending than it used to. I mean, the amount of banks that we have to touch just to get term sheets for construction lending. Let's say before COVID, it was you talk to 4 or 5 banks, 2 of them gave you a term sheet. Now it's like you talk to 30, and maybe one of those gives you a term sheet, right? So a lot of banks have really shied away from it. It's definitely out there. It just takes a lot of more grunt work. I think most of the construction lending kind of shock that people are seeing is how much more equity it takes to get stuff done, because that construction loan needs to be able to be taken out by a perm loan, and with higher rates, right, the cost of capital is higher, and the deals just don't underwrite similar to like the way they did before. Like I was seeing rates were super low, seeing a lot of construction loans go off at like 80%, and if you've got a 4% agency loan that can take the thing out, it underwrites beautifully.
Right.
But now they're 6.5% or so, or something like that. And, that underwriting is a lot more difficult. So what's really translating into is just like more equity that these deals need, because it's not like lenders won't go to higher leverage, but they have to be able to underwrite it based on where rates are today to be able to get taken out. And they can't make some judgment call that, oh, don't worry, rates will just be lower in the future. It's got to work today. So that's the biggest issue I see out there as far as construction lending.
And the challenge that we're seeing too with these ratios changing, if you need to with that much more equity, then the return on equity is not as attractive as it used to be with higher leveraged
Right.
projects.
Right.
So now
Yeah.
the
I mean,
investors are
unfortunately, the
looking at
cost of
it.
capital went up a lot faster than like the underlying economics did. And it'll catch up with it
Right.
eventually, right? And that math will math better. And it just takes a lot more equity to get those deals done.
A lot of different products that I personally knew little about, prior to the recent rise in interest rates. I was looking at PACE loans. Somebody was recently talking to us about TIF,
Mm-hmm.
tax increment financing.
Mm-hmm.
There was, I forget, there was another um, structure, but how useful are these other programs? And do you find that they have, it's mostly a gimmick, or are they actual legitimate ways to fund deals?
I mean, listen, pace works sometimes is the best way to put it. It's not available everywhere. And I wouldn't, when you go into like a pace financing deal, especially with construction, I mean, optically you get like one rate against that pace loan, but there's a lot of fees and like, other costs, and like that thing is fully funded day one that are kind of involved with it. So I wouldn't say it's like the cheapest form of capital out there. The other issue but it definitely has like some great use cases. For instance, I was doing here's a good example, a car wash deal, and it's like $10 million total cost. And the bank I was using would only give a 10-year amortization against the equipment. Pace was able to come in and do a 25-year amortization by replacing the money that we needed for the equipment with 25, so a lot better cash flow coverage. So it's not just about like lower rates or cost of capital. The other challenge with Pace is like a lot of lenders just don't like it, right? It's not, I think when Pace originally came out, like a lot of people were pitching it as equity, which it's not, it's debt. It can't be accelerated. I get that, but it's attached to like the tax assessments, which is definitely in front of the senior lender. And that's how they're viewing it, right? So Pace isn't necessarily getting a higher loan to cost in most instances. It's just replacing, other senior debt. You know, TIF money, I think is great. Any government money you can get, absolutely take it, go for it. It's your tax dollars hard at work. Not everybody can get that, right? But I think all of this stuff is just symptomatic of what's going on in like the macro stuff in the economy, right? And it's just symptomatic of like a high cost of capital and people trying to make that math problem work. And sometimes these alternative products can do that. But I don't think it's a silver bullet for everything.
So there's no, I mean, typically don't even silver bullets, right? They don't exist. But what is the, short of just raising as much equity as you can get your hands on, what is the best approach to, present the most attractive package to a lender?
Um, I think the best approach, like when I'm presenting a deal to a lender, right?
Mhm.
I like to have everything, like all the major deal points, pros and cons, whatever it is, really displayed up front, and organized, right? Presenting loans is, and I've said this many times, like almost more of an art form than a science. Like, don't forget you're dealing with just human beings and people on the other end. And the way
Right.
that some people present stuff to me is just, I'm like, oh my God, I don't even know what I don't even know what the scenario is, right? I mean, they just send like a screen of something, and how are you ever going to get something done here? I can't even make head or tails of this. So I would say like either use somebody like me who can present it the right way and organize all your stuff and present it the right way, or if you're going to go direct to a lender, organization and making sure all the important points are displayed up front. Um, again, pros and cons. Like if you have bankruptcy in your past, tell the guy. If you don't, it's going to look like you're hiding something. And like if it comes out during the loan process, it's probably going to kill the deal. But if you upfront about it up front, then it's something that can easily get over, right? So that's really what I think are the most important things. Like be very upfront about the deal, all the factual information up front, and organization more than anything, man. Like that's what helps the most. And just keep in mind that you're dealing with people that need like a loan officer at somewhere, right? That needs to be able to take your information and then go present it to somebody else to get approval. And they don't have any idea about your deal at all, unless it's outside of the information that you're giving them. So I think that's definitely a good point that a lot of people should take in is like, they get so enveloped of their deals that it seems like second nature to them, but anybody else they're talking to has no idea about this deal.
Yeah, that's been my experience is that you can develop a good relationship with a loan officer and they would be the believer in your deal and they sell their whatever financial institutions and you think okay it's a done deal and then you submit the package. That package goes to an underwriter who has no idea who you are, knows nothing about the deal, and then they start scrutinizing everything and you feel like you're defending yourself at every corner when an hour ago you thought it was a done deal.
Right. Well, keep in mind, loan officers at banks, they're not really loan officers; they're sales guys, right?
They're salespeople, right?
And what are they selling? They're trying to sell money, and they sell you on the relationship thing and everything, and it's like bring it in, and then they hand it off to a bunch of people. So yeah, I mean, it doesn't matter how many times a guy buys you lunch, like it's this thing's still getting underwritten. Like you're not getting $5 million just because you're friendly with the loan officers. It's got to work. It's got to get done, for sure.
Right. Right, exactly. Exactly. So when you guys present deals, do you do full underwriting in-house yourself and put together your own package, or what's your process?
I mean, we underwrite the property level, and you know, I don't usually do like a full global underwrite on like a borrower. That's just an enormous undertaking. A lot of times, most people have like 40, 50 different K1s, and just that's too much time for us to spend internally. But what I do try to understand is the major salient points, credit wise, property wise, and like, does the deal work? And kind of go over like, guarantor structure, org chart, stuff like that to make sure that like it's my job to get this thing, you know, 80% of the way there every single time and make sure that whoever I present this to has vetted it with like their higher ups and their board and their credit to make sure that like, hey, you're not hitting concentration limits with what you're doing and that we have a free runway. So I mean, I wouldn't say we do like a full bank loan approval internally to us, but we bring this very far and we vet both sides, right? The borrower and the lender to make sure that like, hey, everything works out well, the deal's going to get done.
Cool. Do you use any cool new technology to simplify your process? The
Um,
reason I asked, I was recently talking to someone who uses AI. They've got like this whole AI interface that helps loan officers underwrite deals and review deals. What's your? Do you have some magic
Nothing
secret
works
sauce?
better than just having an analyst. I think AI and software stuff and all that, it's great. Everybody submits all of their documentation to me the exact right way. But that never happens. I mean, sometimes I'll get P&Ls that are pictures, they're JPEG files. Sometimes I get P&Ls that are PDF. Sometimes I get them that are Excel that some guy just made. Like there's, so we don't really. We use analysts that really go through things and have like human touch, and do it the right way. If I'm try to plug everything into some AI model, I just don't think that stuff is there yet. And it'll work some of the time, but I think it's going to get jacked up a lot of the time. And even so, you'd have to have somebody fact check that stuff anyways. So,
Right. What else? What else would you like to share, Jake?
um, I don't know when this thing is gonna air, but I could just share some like general, market stuff that we're seeing. I mean, I would tell you investor sentiment since the election has just absolutely exploded. The amount of deals, the amount of calls I'm getting, and like booked calls we have all day long. I mean, I'll be honest with you, my day starts at 8 o'clock starting to take calls. I have booked calls every single half hour all day long until 5 o'clock. Just, it's been like that since the election. So like, and I've heard that from almost everybody. So this market is definitely back. There's deals that are getting done. People want to invest money, which is exciting because things were really frozen up for a long time. But yeah, I mean, the past couple of weeks have just been phenomenal, since the election happened. So it's great to see, and hopefully that definitely continues on in the new year.
Awesome. Yeah, that's good sentiment. Obviously, today's November 14th. So it's only been a little over a week.
And yeah, but I mean, it was so interesting just how fast it happened. I think a lot of people just wanted to get over that and see what's going to happen,
Right.
regardless of who ended up in the White House. It doesn't really matter. It's just one thing that was done with now, and
It's the uncertainty.
yeah, the uncertainty's off the table, and people are ready to get back in and start getting deals done. So, I mean, just the sheer volume of deals I've seen since then is pretty impressive.
Cool. Well, awesome. I hope that whoever's listening, if you're looking for any financial support, debt or equity, please take Jake's number, give him a call, or visit his website. Jake, where do we find you?
I'm super easy to find. Jake Clopton on LinkedIn, or our website's cloptoncapital.com. Or give me a call anytime. I'll take every call and we can chat about deals.
Thanks again, Jake.
Real estate development. Real estate development. Real estate development. Land to legacy.